Hi, my name is Tom along with Daily FX, and today I'd like to discuss with you about the stochastics indicator. It's actually one of my favorites, so I'm really excited to be able to share this with you. Now, in order to use a technical indicator to understand what it can do for you, I think it's important to understand, first of all, that they are tools designed to help you time your entry. Okay? And stochastics is simply comparing the closing price to the range and then going back over the last few days. You designate how far you want to go back when you put in the values of the indicator to find out whether the market has momentum is moving up or moving down. Because when a market is moving up, the closing price has a tendency to be near the high of the range, and when the market is moving down, the closing price has a tendency to be near the bottom of the range. And that's basically what the stochastics is showing us. Okay? Now, stochastics is made up of a number of different multiple points. The first one being what's called slope, or the percent K, which is the raw value of the stochastics. Okay? Now, there's also another point on that, and that would be the percent D, which is simply a moving average of the raw stochastics. Now, that would be the fast stochastics, those two inputs. Now, there's also an indicator which I prefer, which is slow stochastics, which is nothing more really than a moving average of the fast stochastics. Okay? So I like to use a 15, 5, and 5 input on mine. Now, it's kind of funny because I came from a futures and stock background, and most of the charting packages would have default settings of 14, 3, and 3. But then when I moved over to the Forex markets, typically a lot of them would have default values of 5, 5, and 5, or even 5, 5, and 3. But I prefer to slow them down because I prefer less signals that are more accurate in my trading. I don't need to be in a lot of trades, but I do prefer to be in a lot more winning trades than losing trades. So I slow it down to 15, 5, and 5. 15 representing, for instance, on a daily chart, that I'm looking at the closing prices compared to the range for the previous 15 days. Okay? 5 being a 5-period moving average of the stochastics, and the third 5 means it's a 5-period moving average of the 5-period moving average. Okay? So basically, like most of these indicators, they're really just fancy moving averages, which means they tell you where the market's been. It also means they have very little in the way of predictive value. Okay? These indicators can show you changing momentum, but changing momentum doesn't mean a lot unless it's in the right framework. Okay? And that's what I want to share with you today, how I do it. So let's start with a typical trading opportunity and how I would use slow stochastics to help me identify my entry. Now, this blue line would say be a 200-day simple moving average. It is moving down, and the market is below the 200-day simple moving average, which means a strong downtrend, which means I'm only looking for selling opportunities. Okay? First of all, it's key on that to identify your directional bias. If the market is in a strong downtrend, we want to ignore all the buying opportunities that any indicator will generate because they're just not going to be very reliable. We want to increase our chance of success by first identifying the direction of the trend and only trading in that same direction. That increases the value of these indicators and make them a more valuable part of our trading approach. So we've got the market is moving down, a series of lower highs and lower lows. The 200-day moving average is above the market and is also moving down. I'm only looking for selling opportunities. And again, I'm looking for that typical ABC formation. A being the top of a trending move, B is the bottom of the trending move, and then point C represents the end of the corrective move off of the low. Now, typically, breakout traders will wait for the market to move down through point B and go ahead and sell there and place their protective buy stop above point C. Okay? But indicators can kind of help us jump the gun a little bit and maybe get in a little bit early. Number one, lowering our risk, and number two, putting us in a position to get into more of the trending move. Okay? So typically, I'm looking on a selling opportunity using slow stochastics, a crossover after one of the lines or both have been above 80. After they've been above 80, when I'm in this ABC move, I'm looking for that crossover, and that is the point that I'm selling at. Now, that's going to be somewhere between point C and the move down through point B. Okay? Now, sometimes the market will turn around and move up through point C again, but I'm willing to take that risk because, again, my risk on the trade is lower because I'm getting in before the break through point B, and I'm also putting myself in a position to be in on more of the move, thereby increasing my profit and giving me a more favorable risk-reward ratio. But again, the technical indicator is the last thing I want to refer to in my trading approach, not the first thing. The first thing I want to do is identify the trend, make sure I'm in a strong trending market, only look for trading opportunities in the direction of the trend, and then I want to look for a move off of a low if in a downtrend. Otherwise, I'm looking for a rally up to resistance to sell. On the flip side, if the market was in a strong uptrend, I would be looking for a pullback down to support. At that point in time is when I want to use my slow stochastics indicator to help me time my entry. Used in that proper format, whether there's a top-down approach to our trading, that makes this tool valuable input to any trader looking to better time their entries. Again, thanks for joining me. This is Tom Long with Daily FX.